Welcome to Grow Money Business, the podcast dedicated to helping business owners grow both their wealth and business on their own terms. Here's your host, Grant Bledsoe.
Hello, everybody. Grant Bledsoe here. Welcome back to Grow Money Business. This week on the podcast, I'd like to talk about a concept that's made its way into the headlines quite a bit over the last few years. And that's the idea that the 60-40 portfolio is dead, given the current interest rate and economic environment. I'll cut to the chase. I do not think it is dead whatsoever. But I think the reason people invest in the 60-40 portfolio in the first place is often misguided and done for the wrong reasons. So this week on the podcast, I wanted to dive into why the 60-40 portfolio is so popular in the first place, how I think we need to make our investment decisions in light of the current economic environment, and what we might expect out of the 60-40 portfolio going forward. I hope you enjoy it. Hey everyone, I need to interject quickly to remind you all that nothing found in today's episode or any other episode of Grow Money Business should be considered financial, investing, legal, tax, fitness, or even relationship advice. It's content that you're free to use and to deploy on your own terms. And before taking any actions on content found on the show, please do consult with your tax professional, your attorney, or your financial planner. If you don't have a financial planner, head on over to threeoakswealth.com to learn more about what we do in terms of financial planning and investments and how we help clients on an ongoing basis. So this week on the podcast, I want to talk about a topic that has popped up quite a bit in the news over the last few years, and I think is particularly timely now, given that asset prices are falling, interest rates are going up, we have inflation that's driving the increases in interest rates, and stocks and bonds are both falling in value. And the idea or the headline that's been in the news is the 60-40 portfolio dead? The background here is there's been this really popular way and allocation or method of investing, I guess is a better way to put it, over like the last 75 years. And the idea is that if you're approaching retirement, putting your portfolio in 60% stocks and 40% bonds is a really sound allocation because it provides diversification and just leads to these great outcomes. And that's being put to the test right now. And a lot of people are prognosticating. I take that back. They're not even prognosticating. A lot of people are making noise in the headlines because they're trying to attract attention to clickbaity articles, to be candid. But a lot of people are out there claiming that this is no longer a valid method of investing, that the 60-40 portfolio is no longer a useful tool, that we're in a new world and a new environment these days, and therefore people should look beyond that allocation and that strategy when it comes to investing their own assets, either for retirement or otherwise. I believe that's all BS. I don't think that the 60-40 portfolio is any different today than it has been. Yes, we're in a new environment, but I think that people are mistaking the usefulness of the 60-40 portfolio and the reason that we're in the 60-40 portfolio in the first place. So let me back up. Just to set the stage for all this, right now, inflation is high. There are some metrics coming out that money supply is decreasing rapidly, that inflation might fall precipitously in the not too distant future. We may even be in line for disinflation or even deflation starting next year. And that means that prices of goods and services that we like to buy as consumers would actually fall as opposed to rise. Now you think, well, prices have gone up so rapidly on gas and on groceries and on other stuff that I like and need to buy every month, that would be good. Prices going down would be a good thing. It would kind of normalize back to, levels around, maybe where they were before COVID. That sounds nice. That's actually really, really bad for the economy. And the reason is that if prices of goods and services are falling, businesses really start to struggle. They have cash flow problems if they can't charge as much for their goods and services and they have to start laying people off. Unemployment is a big issue all of a sudden. So deflation is a problem and can be really scary for an economy. Now, I don't know that we're spiraling into any deflationary cycle or any of that, but I think there is data that's starting to come out that says that inflation is tapering and starting to recede. Mainly, that's money supply and what they call the PCE deflator, which I'll save you all from today. So at any rate, we're in this inflationary environment right now. It's forcing central banks around the world to increase interest rates to combat that inflation. So the reason here, and just to dive into a few basics, bear with me, the reason here that mechanism exists, that works, right, is inflation is the price of things that we like to buy goes up and up and up. And it's based on supply and demand. If there's more demand for goods and services than availability of those goods and services, then the price has to go up. Back to your supply and demand curves from Economics 101, thinking way back to when you were in college. Now, demand is high right now because people have a lot of money in their pockets. Asset prices are still pretty high. We've printed a lot of money over the last decade plus, really the last 15 years or so since the mortgage crisis in 2008, around then. So people are awash in cash. There's a lot of demand to buy goods and services, and there's not as much supply, partially because we've had supply chain constraints throughout COVID as distribution channels were temporarily disrupted. So that's causing inflation. When the Federal Reserve and other central banks around the world raise interest rates, that makes money harder to come by. It's more expensive to borrow money. People are more incentivized to keep their money in the banks because they earn more interest on their deposits. We're starting to see a little bit of these interest rates trickle down to our savings account rate that your bank might be willing to pay you more and more as the Fed funds rate continues to go up. So interest rates are going up to fight inflation. That's not good for asset prices. It's not good for stocks, and it's not good for bonds. We'll start with stocks. When interest rates go up, that means that it's more expensive for corporations to borrow money to finance their operations. Growth slows down. Again, more people are incentivized to keep money in the banks as opposed to getting it out there into the economy. So their stock prices tend to come under pressure too, because there's more, if you can earn 5% per year on a stock investment with a whole lot of risk and 3% per year on a savings account that's FDIC insured with no risk, well, yeah, you might still choose the stock investment, but more people are going to be interested in looking elsewhere with their capital. So it's more expensive for businesses to operate. Corporate earnings are hurt, and there's more competition in the cash marketplace when new money comes into play and investors are deciding where to put it. Now there's more competition. Equities aren't the only game in town any longer. So that tends to hurt stock prices too. Now with bonds, like we've talked about on the podcast quite a bit, there's this concept of duration risk. And to give everybody the example, I apologize if you've heard this from me before, but it's really important. If you buy a bond that's paying you 4% per year, say you lend the U.S. government $10,000, they're going to pay you $400 a year on that, which is 4% of 10 grand. Every 6 months, they're going to cut you a check for $200. If the market rate of interest goes up right after that from 4% to 5%, then your bond doesn't look so good all of a sudden. And in the marketplace, the value of that $10,000 investment goes down because another investor with $10,000 of cash to invest could lend it to the U.S. government, who's going to pay them 5% per year or $500 a year, instead of buying your bond that only pays $400 a year. So the market value of your bond goes down temporarily. But the closer and closer you get to the maturity, remember bonds are not Most bonds are not issued in perpetuity. There's an end date to the deal. The closer you get to the end of the deal and toward that maturity date, the closer you are to getting your $10,000 back. That's what a bond is. You give the government or some other entity 10 grand, they pay you some interest on that, and then at the end of the term, they give you your money back. So bonds are hurt by rising interest rates in the short term. But in the long term, it's actually good for bond investors because you will get your money back. And when you do, you can reinvest it at higher interest rates. You just need to wait it out and wait for the deal to come to an end. So just to set the stage here today, that's a little bit of background about why asset prices are falling right now. It's because we're in a rising rate environment. People are concerned about the economy, but it's all related to the inflation situation and what the Federal Reserve and other central banks around the world are doing. So we have rates going up. It's pushing down asset prices, both stocks and bonds. Now, back to the 60-40 portfolio. Historically, a lot of people have liked to put 60% of their investments in stocks and 40% of their investments in bonds. And I think a lot of people did that because they liked the diversification benefits of doing so. If you have $1 million in your portfolio and you put $600,000 in stocks, you have $600,000 in investments that are really volatile, that are based on the market's expectation of how profitable that group of stocks will be in the future, and based on the cash flows that those investments will produce. So stocks obviously are a lot more volatile than bonds. A bond is a totally separate instrument. You might be lending money to the exact same institution as the equity that you might own on the stock side, but with the bond, you're just lending an entity money, they're paying you interest on it, and then at some point in the future, you get that money back. So because it's a totally different interest rate, or a totally different deal, a totally different instrument was the word I was looking for a second ago, there's diversification benefits to having both in your portfolio. And a long time ago, historically, stocks and bonds would often move opposite of each other. And when the price of stocks rose, the prices of bonds would fall. And when stocks would crater, people would have this flight to quality and they'd take money out of the stock market, support bonds, and they would kind of move opposite of each other. It's called a negative correlation. And so just by virtue of having more different stuff in the portfolio, that adds to the diversification benefit. And that's the same case for investing in stocks of other countries around the world, emerging market stocks, including real estate and maybe alternative investments in your portfolio. The more diverse a set of stuff that we can invest in, the better the diversification benefits, the better your risk-adjusted return over time. And so there's a great use case for investing in both stocks and bonds in some portion simultaneously because they're just different things. Adding bonds to your portfolio reduces the volatility because it's just a lower risk investment. You lend money, you get some interest, and you get your money back. But if that corporation does really well, that you invest, that you lend money to in the form of a bond, the value of your bond is not going to change that much. The company might be more likely to repay you at the end of the bond deal, at the end of the 5 or 10 years, because they're in a better place financially. They have more capacity to pay you back. But you're not going to benefit as a bond investor from, the huge growth of like Salesforce or Amazon or something like that. A stock investor, you're entitled to a portion of that equity, and that huge growth directly benefits you. Not the case with bonds. It indirectly benefits you because the issuer just has more ability to pay you back when the time comes. Now, so historically, with the 60-40 portfolio, I think most people liked that allocation because it seemed reasonable. You had a nice portion in growth assets, which are stocks, but you had a nice ballast with 40% being in bonds. So even when the market's corrected, yeah, you have the bonds that are going to provide some stability. And that really helped people over the years weather the storm through really volatile periods in the market, particularly in the mortgage crisis. Now, the mortgage crisis was one of the first financial calamities. We have these economic, these tough economic periods every 7 to 10 years, just because of the cyclicality of how markets and the economy works. And prior to the mortgage crisis, it seemed like stocks and bonds would move in opposite of each other. The mortgage crisis was the first one of the first, I think, where the values of stocks and bonds fell at the same time. And you didn't have as much of a diversification benefit by being in both camps as you did previously, which is why some people at that time started raising the question of, well, why the heck are we doing this in the first place? If they're not going to balance each other, why are we investing in bonds at all? I would counter that. And I think that the 60-40 portfolio is not dead. I think it's alive and well, but not necessarily because of the diversification benefits. I think there are diversification benefits of having bonds in your portfolio, but not for the reason that people think. The 60-40 allocation is a pretty good starting place and rule of thumb for a lot of people who are approaching and going through their retirement transition and who are already in retirement. And the reason, probably the best way to explain this is to go back to our example of having $1 million portfolio, 600,000 of it in stocks, 400,000 in bonds. When you're in retirement, theoretically, you're taking distributions from that $1 million portfolio to pay your living expenses. And the idea with this whole thing, sound portfolio strategy, is you're trying to buy low and sell high. And because of the way bonds are structured, you're lending money to some organization. They're probably paying you some interest, and then at the end of the deal, you get your money back. That 40% allocation to bonds is not as useful as for its diversification benefits. It's more useful because that just gives you a longer and better capacity to wait out the tough period in the stock markets. So here's what I mean. If you're someone who's drawing from your retirement assets every single year, let's say that you're someone that has $1 million in your portfolio, you have Social Security benefits, maybe you or your spouse has a little bit of a pension, and you're going to abide by the 4% distribution rule, which we've covered in the past on the show. It's the 4% rule, by the way, is a pretty good rule of thumb. It's not perfect for most people, but it works all right as a starting point. And that's that if you take 4% of the portfolio out every year, adjusted for inflation, you're not going to run out of money. 4% of $1 million is $40,000. So every year you're going to take $40,000 out of the portfolio. Well, if you hit a really tough period in the economy and in the markets, like we're going through right now, where it's time to take money out of the accounts, maybe you take $10,000 a quarter out of your accounts, well, you might not want to take a whole lot of money out of your stocks because stocks have fallen a lot in value. Remember, we're trying to buy low and sell high. Bonds, we know, are going to recover over time. And whereas, it's not great to see the value of our bond allocations go down temporarily, by having money allocated to bonds, it enables you to avoid selling stocks when they're depressed. Bonds are going to be more consistent, even though we're seeing rising rates right now. And if you're taking $10,000 a quarter out of your account, you might need to do so when both your stocks and bonds are depressed. At the same time, we know the value of the bonds are going to recover the closer we get to the maturity date. And on the other hand, I've got a lot of confidence that the value of the stocks are going to recover over time. The thing is, we just don't know how long it's going to take. We have this capitalistic system that really rewards corporate profit making. And if we have money to invest and we put it in the the biggest, best corporations in the world, best meaning the ones coming up with innovative stuff that helps you and me and our society. And they're coming out with these great new things in a way that makes money for the shareholders. It's only a matter of time before these huge corporations figure out how to recover from it and the economy improves. They have the smartest people in these huge teams of really smart people working together to come up with products and solutions and services that benefit some demographic of people and other organizations and clientele. That's why the stock market keeps going up and up and up and up over time and never, falls back to its long-term median. It's because we continue to get more efficient as a society. We continue to come up with these new products and services that people want. We have this tendency as humans to improve things and make stuff better, iteration after iteration, over and over and over again. And if you invest in stocks in general, you are going to benefit from that human tendency. The thing is, we just don't have any idea how long it's going to take the stock market to recover. Sometimes it takes a year or two, right? Think back to COVID when things set in April of 2020. We had this big sell-off. We were in a bear market for about 72 hours before things started to recover. And then the rest of the year, things just took off. The market just did phenomenally after that. Sometimes it takes, a few months like it did in that circumstance. Sometimes it takes longer. It might take longer in this situation for us to recover. But it does recover because humans have this tendency to improve on what's already out there, make things more efficient and better. And we have a capitalistic structure that rewards corporations for doing the market research, finding out what people want, and then coming up with a product or service that meets that need. And guess what? It's mutually beneficial for the equity holders. So that's the whole thing. We have no idea whether it's going to take 6 months to recover or 3 years or 5 years or longer. But the 60-40 portfolio is not going away anytime soon, because when you invest in bonds, it doesn't matter how long it takes for the stocks to recover. Well, let me take that back. It does matter how long it takes for the stocks to recover. The more you have invested in bonds, the longer you can wait out the stock market. So let's go back to our example. Let's say you have $1 million invested, 600 grand of it is in stocks, 400 grand is in bonds. The stock market is down. Yeah, I know I need to wait it out, but I'm a little skittish. I don't want to, wait that long. Well, for your bonds, that's going to produce a predictable amount of income, of interest. And so if the weighted average maturity of your bond portfolio is 5 years, and you're taking $10,000 a quarter or $40,000 a year out of your accounts, remember that because that's 4% of $1 million, then you've got bonds that will cover a lot of your, you have a bond allocation that will cover all of those distributions without you needing to touch any of your stocks while they're depressed in price. So here's another way of thinking about it. You have 10 years worth of cash distributions sitting in bonds. If you take $40,000 a year out and you have $400,000 invested in bonds, that's 10 years worth of cash distributions. And so what you want to do with your bond, with the bond side of your portfolio in a 60-40 setting, is depending on your distribution needs, you want to set your maturity in a way that's shorter than the total cash runway you have in bonds. The bond side is your war chest. That's the fail-safe. And if the average maturity is 5 years and you have 10 years worth of bonds on that side of your portfolio, you've got plenty of cash. You can wait 10 years for the market to recover without selling any stocks at a time when they're depressed. Now, I'm not an advocate for increasing your equity allocation when that happens, right? So a lot of people will say, if the value of stocks goes down, Doesn't that mean that I should sell all my bonds and load back up on stocks? That's not what I'm saying. I think if the value of stocks falls and the value of bonds stays consistent, then you should sell a little bit of bonds and use the cash to buy stocks to bring you back to that 60-40 allocation. But in the long run, the reason that the 60-40 portfolio has worked and will continue to work is not just because bonds provide diversification benefits, it's because there's a term limit to the bonds. And you can structure your cash needs around that buffer. The bonds are your war chest. The more you have in bonds, the longer you can afford to wait out the stock market and allow it to recover. Because over and over again, we have a mountain of evidence that confirms that the stock market will recover. It just takes a while. And the longer that we can wait out the market and just allow it to do its thing, the better off we're going to be. And the portion that you should have in stocks versus in bonds or in other stuff depends on how much you need to draw from your portfolio. If you don't need to draw anything from your portfolio, then if you're comfortable with it, you could afford to have a lot more of your accounts in stocks. If you need to draw a lot from your portfolio, then you should probably consider increasing the allocation to bonds to provide a little bit more stability. But it's not just because bonds provide some diversification benefits. And even in this environment with rates going up and bonds and stocks both going down at the same time, I get it. There's not as much diversification there. And I get it. If you're taking money out of the bond portion of if you're taking money out of your accounts, you don't want to touch the stock portion of your portfolio. You want to draw on bonds. I get it. The value of bonds are down right now too, but they're not down by as much as stocks are. And it is a mathematical certainty that as the closer that you get to the maturity date of the bond, the value of that bond will recover as long as the issuer can pay you back, and the creditworthiness of that issuer doesn't change. And that's a totally different story. That's an economic story and depends on the operations of that specific company or government or organization or whatever. So at any rate, those are my thoughts on the 60-40 portfolio. They're not going away. It's not going away anytime soon. We're just in an environment where both asset classes happen to be falling at the same time. But the same fundamentals of investing hold in that, and that's that if you have a long-term focus, higher interest rates are a little painful in the short term, but are probably better off for you in the long term. And as long as your time horizon is longer than the duration or average maturity of your portfolio, your bond portfolio that is, higher rates are actually better for you. You just have to wait it out a little bit. And on the stock side, there is absolutely no guarantee that stocks will recover, but there's a whole mountain of evidence that suggests that our system will promote that recovery over time. It might take 6 months, might take a couple years, it might take 5 years or maybe even closer to 10. I don't know. But when we think about portfolio structure, we just need to give ourselves the ability to wait that out. We shouldn't be in the business of trying to guess how long that recovery will take and then making an investment decision from that angle. We should make our investment decisions based on our cash needs and our comfort level with that risk, knowing that we have no idea how long it'll take to recover or know whether large companies or small companies will do better in the next 12 months or whether Ford or GM will do better. We don't know any of that stuff. The better strategy is just to invest in all of it and let the market do the work for you. So those are my thoughts on the 60-40 portfolio. I got off on a little bit of a tangent there in a couple of ways today, but I hope it was helpful. For you younger folks who don't need to draw from your portfolio, that's precisely why you don't need as much in bonds. We like to include bonds in most people's portfolios because it does tend to dampen the risk a little bit. It makes these wild swings easier to stomach. And the whole reason that we want to add them is because when they're easier to stomach and we can withstand these swings in the market, that gives us a greater likelihood that we can wait them out and wait for things to recover. And that's the whole key, is just being consistent and maintaining a consistent allocation throughout all market cycles. And then just let the market do the work for you. We don't have to guess what's going to happen next. And the way that we shoot ourselves in the foot is when we see the values of things falling and we want to sell and get out and wait for things to recover, because we don't know when they're going to recover. And if you're out of stocks or bonds when that recovery hits and you miss it, that has a huge impact on long-term returns. And there's a chart I'll find and add a link to it in the show notes. But I think it's something where if you take the 10-year rolling returns of like the S&P 500 or any large cap U.S. index, and you take the average rolling 10-year returns, you get something like, 9% maybe over the last 50 years. I'm pulling that out of thin air, but it's around 9%. And then if you take away the 5 best trading days for investors, so the 5 days with the largest daily returns, that return goes all the way from 9% all the way down to like 7.5%. And I'm pulling this out of thin air. Please look at the chart. I can't remember exactly what the numbers are, but it has a dramatic impact when you miss those big rebound days. And guess what? Those big rebound days happen to be at the very bottom. So you have to. It's a bigger task than I think most people assume to guess and get out of the market and wait for things to recover and then get back in. That's a tall order, and doing that successfully is a high wire act where you are more likely to shoot yourselves in the foot than to add any incremental benefit to your long-term returns. Because if you miss the biggest rebound days, it just has a really dramatic effect. And yeah, if the market has another 20% to fall from here and you sell today, then you miss that 20% fall, and that can be beneficial. But how do we know that this isn't the bottom and it'll rebound on Monday? We simply don't know that. Okay, so those are my thoughts. I hope this was helpful. The 60-40 portfolio is not going away anytime soon. The returns we might expect from the 60-40 portfolio over the next 10 years might not be that great, but that's not how you ought to be making your investment decisions. Your investment decisions ought to be based on planning and your specific circumstances and need for the cash and all the other stuff. Tax, income, all the other stuff we talk about on the podcast. All right, I'll call it for today before I ramble on any longer. Hope this was helpful. Talk to you all again soon.
Thanks for tuning in to Grow Money Business, the podcast dedicated to helping business owners grow both their wealth and business on their own terms. Be sure to subscribe to the podcast on iTunes, Google Play, or wherever you digest podcasts to ensure you don't miss out on future episodes and announcements. And feel free to submit questions to growmoneybusiness.com.